Thank you for taking a few minutes to learn more about the investment and tax advantages of purchasing residential single-family homes as an investment vehicle. If you've clicked on the Who Are We tab of our website, you'll learn that IBAREE is helmed and operated by Michael D. Finn, a licensed real estate broker, attorney, and a former certified public accountant. He was first licensed as an attorney in Michigan in 1970, a CPA in 1974, and a real estate broker since the early 1990s. Mr. Finn is also the president and actively involved in the daily operations of Finn Law Group and Investors Business Real Estate Emporium. We should note that neither Mr. Finn nor other members of the IBAREE staff are investment brokers or bankers. Because this presentation is in recorded format, so that you may view it at your convenience, you won't have the opportunity to ask questions in real time. Of course, we're happy to receive your questions via email or telephone. Unsurprisingly, you can find our contact information on the Contact tab of our website. As our title slide suggested, real estate is like all investments. One must measure the return on investment against the risk. Diversification is the key to spreading out that risk by placing it among more than one investment vehicle. Where single-family residential may fit into your portfolio is entirely up to you, with perhaps the advice of your investment counselor. This is where I reiterate that we are not investment counselors. Obviously, real estate's most serious consideration must be its relative lack of liquidity. This suggests a well-rounded portfolio would contain significant liquidity. All financial markets have peaks and valleys. Timing is important when entering the market. We feel this aspect of real estate, that of residential single-family homes in stable housing neighborhood, priced in the $90,000 to $175,000 range, and of the configuration most popular, 2 to 3 bedrooms, 1.5 to 2 baths, 1 or 2 car garage, are at historically low levels and should begin to reappreciate significantly over the next 5 to 7 years. In fact, if you're looking at the Tampa Bay Times or the St. Pete Times in recent weeks, you'll see that we're just beginning to see a turn. A recent Wall Street Journal article suggests a relatively low risk of stable family-based housing in middle-class neighborhoods. For a moment, let's talk about homes, not as an investment but as shelter. While it's true that mortgage rates are at a historical low, many potential homebuyers are simply not able to get back into the market because of credit and/or down payment issues. So presumably, the best purchase deals will go to those who recognize the value at today's prices with the intent to resell in 3 to 7 years to optimize appreciation rate of return, a profile more of an investor than of a typical homebuyer. There are major tax advantages of investing in real estate, and these include your ability to offset against ordinary income the non-cash deductible expense known as depreciation. Current IRS regulations permit you to deduct about 1/40 of your capitalized investment as depreciation every year. Since your intent is to at some point resell your investment at a profit, if things go as planned, the depreciation write-off allows the deferral of taxable income until after the sale and capital gains treatment on all profit beyond your original cost. Depreciation recapture is taxed at ordinary income rates, but even that is avoidable if you acquire your real estate investment through your IRA, 401k, or other permitted retirement plan. We'll talk about that in a bit more detail shortly. Beyond depreciation, all expenses reasonably related to your investment, including things like travel costs to oversee your investment, are tax deductible and therefore an offset to ordinary income. Generally speaking, if you opt to use funds not in a retirement plan to acquire your investment, you'll still see favorable tax consequences, such as those just indicated, from the time you buy right through to the time you sell. Acquiring your investment through your retirement plan is an option, but not generally known about because your retirement plan's funds are generally in the hands of a third-party plan administrator who invests your funds in the stock, bond, or money market, or a combination thereof. Those are their products, so they're likely to promote them, and not other investment vehicles like real estate. As I mentioned earlier, these traditional retirement funds are typically quite liquid, meaning you can convert them to cash relatively easily. My real estate investment concept incorporates the idea of leaving a significant portion of your retirement funds in liquid investments within your plan, but also encourages diversification by utilizing a portion of your funds in a self-directed retirement plan that facilitates investing in real estate among your options. For specifics as to the mechanics of obtaining a self-directed plan, which allows you to shift, not distribute, a portion of your retirement plan into a self-directed retirement account, which is absolutely sanctioned and permitted by the IRS. I'm most familiar with a company called Advanta IRA, formerly known as Entrust. We at IBAREE know the operators of the local Largo, Florida office, and we're happy to refer them to you. Jack Callahan is the president and also a licensed Florida attorney, as is Jack's associate, Scott Maurer. Their contact information will be provided to you on our website. To summarize the advantages of investing in real estate via your retirement account, let's refer to this slide, which advises that all gains are tax-free until disbursement. If a Roth IRA vehicle is utilized, they remain tax-free. As tax consequences of investment gains are well beyond the scope of this presentation, we'll simply conclude by suggesting you obtain the Advanta materials and forwarding them along with this website to your tax advisor. The bottom line is that the tax treatment is at least comparable to your other investment and at best offers some short-term tax advantages your typical investment plan may not include. One last interesting observation before we move on is that your self-directed plan can partner with other plans, perhaps owned by a friend, relative, a trust, or even yourself. You as an individual investor can also partner and combine investment dollars with your self-directed IRA to acquire the real estate you decide to purchase. Since the best real estate deals on the market are going to those that you purchase outright without outside financing, our vision is that by using your retirement or savings account dollars for your acquisition, you'll not only be able to drive the best purchase bargain, but you'll also be able to close your purchase quickly, which will be important to your awaiting tenant. More on that in a moment. Therefore, you should not conveniently have the necessary funds on hand for the purchase you'd like to make. The ability to partner up your investment with a friend, family member, or even yourself, along with your IRA or 401k, may be the way to determine how much of an investment you and your group will want to invest. Now that we have the funding portion well in hand, let's look at the business plan. First, rather than have you select the home to acquire, we match you, the investor, with a pre-qualified tenant for the home before the home is even purchased. The concept is that we're trying to build an exit scenario for you and attempt to match you with your new tenant and future purchaser. Again, a little bit more on that in a moment. Then, with you, the investor, retaining the ultimate buying decision, the tenant selects the home of their choice from the available MLS listings and or bank-provided list of properties within its portfolio in the tenant's desired area. By allowing the tenant their choice, we feel the tenant will have that much greater an incentive to exercise their option to purchase the property from you when they are in the position to do so. Second, and more importantly, the rate of return you can realistically expect from your rental translates into 7 to 9% rate of return pre-appreciation. Please refer to the schedules attached to our website for the specifics of how these rates were calculated. This next piece here merely illustrates projected anticipated cash flow on a $100,000 home purchase at a 10% rate of return. Why 10%? As stated, the non-appreciation rate of return from lease collection is only from 7 to 9%, so it's fair to anticipate an additional annualized rate of return from the appreciation of the asset. That is to say, the appreciation of the real estate itself. As indicated previously, we recommend purchasing with cash to obtain the best purchase price. We build in a minimum acquisition price to the tenant of 120% of the investor's base of the purchase price, plus any improvements over the 2 to 3 year projected rental period. We believe this number is realistic, particularly if purchased at the bottomed out price with cash to obtain an even better deal. Over a 2 to 3 year period, the tenants who have selected the home initially and made improvements over this time frame will be paying a fair price at 120% of initial cost. Going back to this slide, at 10% we're only attributing a 1 to 3% annual appreciation rate, which we feel is low, given the added 6 to 7% annually should the tenant buy at 120%. Even at a modest 100%, the initial $100,000 cost adds up to $161,051. In short, we are representing a very conservative estimate of the sort of return that can be attained. This next piece provides an example of what we think is realistic and still quite conservative. And in this case, $100,000 becomes $178,000 over 6 years. Take a moment to sort of scan through our investment example. How do we get started? We can refer you to your self-directed administrator if you do opt to use your retirement funds to make your purchase. IBAREE then locates your qualified tenants, handles the property acquisition as your real estate broker, and thereafter manages the property right up to the day of resale. Our intent is to allow a typical investor to acquire real estate with absolutely none of the typical landlord hassles. IBAREE does it all. Its management fees are built into the rate of return, so the numbers you see include the 7% management fee already deducted. The investor has the identical investment experience he or she has with any other market, receiving a monthly accounting with their check, no concerns about locating or vetting a tenant, and hopefully a built-in exit scenario if the tenant ultimately purchases the home. IBAREE marries the tenant to the home from day one, thus ensuring the tenant has the desire to own the specific home as soon as possible. The investor will go out, set some parameters for the price and the location of the home they want to invest in, and then IBAREE will pair them with well-matched tenants. That tenant is identified and pre-qualified first, and then they're allowed to select the home they wish to occupy. If it fits within the investor's guidelines, they'll have the opportunity to rent and then later purchase from the investor. This unique matching approach increases the probability that the tenant will ultimately purchase the home. A built-in exit scenario. To recap, the tenant will exercise their option to purchase the home within 2 to 3 years. Note that to purchase, the tenant will need to have a budgeted 10% down payment to make the purchase. The investor, that's you, provide financing on land contract for an additional 2 to 3 years, meaning that you still hold the title to the home, but are starting to collect mortgage payments instead of rent. If the tenants qualify for conventional financing sooner, then both parties can benefit from an early cash out. And our last slide summarizes the concept, the process, and the investment. Home investing with absolutely no landlord issues, with a great projected return on your investment, excellent tax benefits any way you finance, and a built-in exit scenario.